But the rupee and bonds largely remaining steady. This after the Reserve Bank announced a 40,000 crore rupee buyback of government securities. Now remember, the last three buyback auctions by the RBI saw a tepid response. So what exactly is a bond buyback and how can it boost liquidity in the system? Ritu is standing by to explain. Ritu.
Well, the RBI has announced this fourth buyback of 40,000 crore worth of government bonds, despite what you were calling was a tepid, muted, or rather unenthusiastic response on the last three buybacks, which were attempted earlier this month. Now, the securities offered for buyback are four government bonds with maturity dates in the second half of this year itself. Now, why did the government announce this buyback? Well, the government is sitting on substantial cash balances with spending muted because of elections on one hand, and of course, that huge dividend from RBI also coming in. So the government wants to use this cash balance to repay a portion of its outstanding borrowings prematurely and ease the pressure of any future repayments. Now, in an ideal situation, buybacks can also bring down the government's interest cost because new demand should push up bond prices and hence lower the yields because of the inverse relationship between the bond prices and yields. And since banks are the largest borrowers, or rather holders of government bonds, the buyback operation should also help infuse liquidity, which has been in deficit. So it sounds like a win-win, but in the actual scenario, the last three auctions have been a bit of a fail. Out of a total of 1.6 lakh crore of bonds that were offered for buybacks, RBI accepted bids worth only about 18,000 crores, which is barely 11% of the amount that was on offer, which brings us to the question about why the response has been so poor. Well, in the past three auctions, banks, of course, want to sell bonds at higher prices or lower yields for a profit, understandably. But for RBI, this creates a problem. And that's because if RBI accepts bids as these higher prices and lower yields, it's going to signal to the markets that the RBI is comfortable with the lower yields or lower rates, and that represents easier financial conditions. And now with inflation running above 4%, RBI does not want the markets to start pricing in the rate cuts yet because it is not comfortable with yields front-running monetary policy actions. So, which is why we've been seeing this kind of a poor response, and an interesting space to watch out for, because after three muted auctions, it's going to be very surprising if the same, bonds that are being offered this time around as well are going to yield any different results.
All right, Ritu, we will have to wait to see. Many thanks for joining us with that explainer.